Well, thank you very much. Oh, I have to put my switch on somewhere. Sorry, I'm professors are always. Is that better? It's still not on? I have to hold the button longer. How's that? Good. Thank you. All right. Too many pieces of equipment. We'll work it out. Well, as I said, thank you very much for coming and giving me this opportunity to speak with you about, as the subject matter here, it's a bit of a pretentious title because it suggests I'm going to cover all of the foundations, but I wanted to indicate that the context, or broad context of the talk. And as indicated, what I want to do, this is my agenda. I should say I am very pleased that you have the slides in Korean in front of you written out. Because as you'll see, I don't go slide by slide. I'm going to talk to you. All of you, I hope. And if what I have to say may not be so clear in my English, you have it there. So, here's my agenda for today. I think of the investment process, the way I think about it, is really two stages, two parts. First, create the best performing or most powerful risky investment engine you know how. The best one. If it were a car, most horsepower. Okay? As an investment vehicle, what do I mean by best? The one I'm going to measure the one with the largest Sharpe ratio, right? Expected excess return per unit risk. If you think of the curve, risk return, the steeper, the better. We all agree. Now, there are other measures, but even though the Sharpe ratio, capital asset pricing model, and so forth, which I know you all know, is 50 years old, if you look today, we've made much progress, but we still measure performance and risk in terms of things like beta, alpha, and so forth. That means you're dealing with, pardon the covariances and so forth, you're really in the regime of trying to get the highest Sharpe ratio. So this is the way we are really operating in the investment industry today. And indeed, most of the resources, or many of the resources, probably most, at least in the investment area, are dedicated to trying to get that higher Sharpe ratio. So what I mean by the best engine is you get the highest Sharpe ratio you know how to do a portfolio, without regard to what it's ultimately going to be used for. So you don't need to know the purpose of the portfolios that this is going to be used for. Once you have that sort of universal best machine, then the second part of the process is to look at the objective of the particular portfolio that you're responsible for, a particular objective, and then optimize the objective. But the way that optimization takes place is by dynamically mixing your best engine with the risk-free asset. And I'll speak a bit about the risk-free asset. So if you look at this chart here, I use this all the time with my colleagues, even on specialized project. This is my view of the whole investment process, from the beginning to end. What I'm talking to you about now over here is creating what they call the optimal combination of risky assets, the largest Sharpe ratio portfolio. Oh, I need to look at the time to make sure I don't run over. Here, so leaving this aside, I'm talking about first, make the best engine you know how. That will include, and then when you mix that with the risk-free asset, that's one way of managing risk. It turns out that the best engine, as a practical matter, is the best engine for almost any, to be used in almost any objective. It's robust in that respect. What's affected by the objective is what's the risk-free asset. Simple example, if you had a sterling customer client who wanted to hire you to manage the Korean stock portfolio, the risk-free asset for that client is a sterling asset, not a won asset, or not a dollar asset. So that's very important. So for a portfolio for a sterling investor, that is very important. What it turns out is the net return, that is the difference between the risky portfolio and the risk-free portfolio, if you like the excess return, is relatively insensitive to the goal, the currency or the goal. I'll come back to that. So that's why I believe you can put that together conceptually, separately from any particular goal. This is a little different. Then you mix the two, you get what you all know is the optimal mean variance portfolio. I'll leave this out. But then over here is where you introduce the goal. What happens is you mix this best engine with this dynamically through time so as to optimize the particular goal. And because if you have different goals, then the dynamic strategy will be different. Even though the components being mixed, if you like, this is the cross-sectional mix in this portfolio of risky assets. It's the cross assets. Mixing these in different mixes through time is the way you achieve optimization of the goals. So there's two processes separated. Giving you that as context, today I'm going to spend most of my time on the first, namely getting the best optimal combination of risky assets. Okay? And in doing so, I want to be very precise in my definition of alpha and so forth, so we're very clear what I mean by those, because those terms get used today in much different fashion or different places. And so what I'm going to start with is a model, or what we all know, the capital asset pricing model, CAPM. What is the empirical statement of that model? It says if that model is good enough to describe the world that we're interested in investing in, then it is the case that the optimal combination of risky assets, the highest Sharpe ratio, is the market. A cap-weighted portfolio. It's very clear. Specifically, that's the best in terms of the best Sharpe ratio. If the capital asset pricing model were good enough, this lecture would be very short. Because I would say the best risk engine is a whole cap-weighted portfolio. Now, by the way, that may be the best strategy for many, depending on their information sets and so forth. It is not a strategy that's embarrassing. Indexing, I think the first index fund was actually 1970, Stagecoach Fund, but the really big indexer that started was Vanguard in 1975, and it's now one of the largest pools and so forth. So indexing is a strategy which more or less will beat about 87% of active managers each year. It's not something to sneeze at. It's not a bad strategy, and it's one that you'll never be convicted of doing something silly or stupid. That said, we can improve it because I'm going to make the case to you first that the capital asset pricing model fails to be good enough. And if it doesn't hold, if it does hold, indexing is the best. If it doesn't hold, then we know there's some other portfolio that has a higher Sharpe ratio, a better performer than the index. Alpha exists. Alpha, I remind you, is simply an indicator that if there is a true alpha, the capital asset pricing model fails. If there is a true alpha, there's a portfolio better than indexing. Those are all the same statements. So my agenda will be, one, to make the case very briefly, because I don't think I have to spend too much time on it, that the CAPM is not good enough. It fails. That means there's alpha. Then what I would turn my attention to is, where do we find alpha? What are the sources of alpha? Where do we find it? And how can we make use of it? And I want to introduce to you for today 3 different kinds of alpha. And I'll explain each of them to you, I hope, if I do a good job, in a fashion that they become yours, meaning you see the argument and you think it makes sense to you. You own it. I should say, I will not take, no one here should recommend anything to be done on the basis of saying, we heard Professor Merton say that was a good thing to do in a lecture. You put too much of a burden on my shoulders. I have enough trouble being responsible for what I say. You can't do that. I want you to think of my role here today as not to tell you what to do, but as a guide, to show you things. And when you've looked at them, if you like it, and you say, that makes sense to me, then you own it. Not me, you. You get all the credit for it if you choose to use it. If you recommend it, it's not because I told you, it's because you believe in it and you can explain it. But that means you also take the responsibility for it. So do you understand the task here? My job, if I succeed, has been a good guide, not to tell you what to do. Okay. So if you understand that, what I'm going to do is say, once we've established alpha, show you the sources of alpha, show you why it's interesting to understand the sources for the purposes of professional investing. This is very targeted. If I can do that, I feel I've accomplished the first part. I hope also I will spend some time on the concept of goals-based investing. I will do so in part because I believe that goals-based investing is going to be a much bigger trend than it already is in the future. And I'll explain to you what. So after showing you how to think about the best engine and perhaps a different way of thinking about alpha, understanding it, then I'll talk to you about that. So that's where we're going. The 3 alphas that I'm going to talk are 3 sources of alpha, which I'm going to go through in just a few minutes. You don't need to, whoops, sorry, I'll get this. This slide. I am going to spend almost much of my time talking now on this one slide. You won't have to turn pages very much. The other slides fill in for you for future. They explain what's on this page in more detail. I'm not a slide person, so don't write it. So, as I said, first order of business, is the CAPM good enough? Answer, no, it fails. When did we discover that? What's the evidence for its failure? This is not news. 40 years ago, some of my colleagues, Fisher Black, Myron Scholes, Michael Jensen, and in separate papers, Gene Fama and Macbeth, demonstrated that the CAPM failed in the statistical sense because the security market line, the relation between systematic risk beta and excess return, was such that it was too flat. High beta stocks earned too little, low beta stocks earned too much, and statistically at a very high confidence level you could reject it. And there were other studies, and those studies have continued for the last 40 years, and the answer continues to be not good enough. It fails. Now before proceeding, some of you, well actually all of you compared to me, are a young group, and so I know most of you have studied finance in business school, and I know most of you, if you did study it, you had the capital asset pricing model, right? You were taught that at school. Now you might say, wait a minute, I mean for 40 years we knew this wasn't good enough? and they taught it to me, should you ask for your tuition back? Teaching the wrong thing. Well, there's a point here. The CAPM is not a wrong model. It's a too incomplete model. We all know every model is an abstraction from complex reality and thus incomplete. It doesn't explain all. But the notion of not being too incomplete means it's not adequate. Maybe I could do, we all had in high school algebra, a circle, the circumference, and the diameter, right, of a circle. The ratio of the circumference to the diameter is what? Anybody know? Do you remember from school? Pi, very good. Pi, the Greek pi. What is a model of pi? 3.14. What's a less incomplete model of pi? 3.14159. Still incomplete because, as you know, pi goes on forever. You never get the whole story. But it's less incomplete. For some jobs or some activities, 3.14 might be good enough a model. In other cases, it's not good enough. The sense in which I say the CPM fails is that it's not that it's a wrong model. 3.14 isn't wrong. It's just too incomplete. And why that's important, among other things, is that's how I would defend your universities you went to for teaching you the CAPM. The CAPM gives you the right concept. You do not have to get rid of it. It just doesn't give you the whole story. You need the 159 as well. I just wanted to say, because I'm not talking out of two sides. So that's the spirit in which I say it's incomplete. So let's accept, I'll ask you at least for now, let's accept the CAPM fails. And if it fails, it means we now know alpha exists. If alpha exists, then we're willing to spend resources to find it and develop it. If you didn't know it exists, you might be worried that you spend lots of resources seeking it and it will all be wasted. So it's important to know it exists. That's useful information. Now the question is, what is the source? Where did this alpha come from? Why is it that the CAPM is not good enough? Now, I don't mean if you walked out right outside on the street, but if you talk to people who are connected in financial world in some way, so they know what the term means, if you said to them, there's an alpha, or so-and-so can produce an alpha, and what is it coming from? I would make a small bet, I don't have a lot to bet, but I'll make a small bet, that they would say it's market information inefficiency. That's a lot of words to say there are some people who are smarter, faster, and have better information, quicker, whatever. And there are others who are slower, not as well formed, and have cognitive dysfunctions, which calls them to misbehave in the sense of do damage to themselves in investing, so-called behavioral dysfunctions. And the alpha comes from the faster, quicker, smarter, earning it at the expense of the slower, and so forth, not so dumber, put it blankly, okay? Now, what are the implications of that? Let's talk about the nature of having differential information. First, that if you knew the entity you were trading with had information, you wouldn't trade with them. Because this world, there's no other reason to trade except because you have a better information and some poor person doesn't. It's a zero-sum game. In fact, it's negative because there are costs, people's salaries and so forth. And we know as professionals that if we think the counterpart who wants to trade with us has information, we would walk away from the trade if that's the reason we're trading. Because we know they may not have info, but if we think they do, they're going to earn an alpha. That means we're going to have a negative alpha. We don't want that. So what does that mean? Well, first it means that when you go to trade, if you indicate that you have information or the motivation for your trade is you think you're smarter, they're going to walk away from the trade. Maybe not a market, if someone's making a market, of course they have to do it. But they will do what to defend themselves? They'll expand the spread, charge you more for the trade, and they'll limit the amount that they'll sell or buy from you. Right? If I go in and say, I want to do 100,000 shares of Intel in the next hour, and the market maker says, well, I don't have any Intel handy, how about some AMD? No, it has to be Intel, and it has to be in the next hour. What are they telling you? They're telling you it's an information trade. And you will pay a price for that. Bigger spread, you can't execute in the size. That's just the nature of it. So the first thing to recognize by this alpha, it's high cost to trade. Doesn't mean you don't do it. It's a high cost trade. The second thing is because it's an information-based trade, the information will, the reason you got to get it done fast is because you're worried the information will get out before you get your trade on. So it's a high cost trade and it's not scalable. You can't do it in big size for the very reason of the very specific and time-sensitive immediacy of the transaction. So this kind of alpha has the features and an implementation of trading, high cost and limited scale. That's not bad, it's just a characteristic. Everybody okay? Now, are there any other sources of alpha? Well, I can't tell you in the real world because no one knows what the real world actually is, but I can show it to you in a model. What if I put into my model that everyone knows the means, variances, and covariances of all the securities? I can do that in a model, right? Then do you see in the model the market efficiency has to hold, informational efficiency. Do you agree? Because everybody knows. Can we have alpha in that model? Answer, yes. Where does it come from? Well, it turns out there's more than one. Let me give you the first one. Consider an example. A Japanese commercial bank has decided it wants to be long the yen curve. It wants to be long, if you like, JGB exposure. I don't know why. That's what they want to do. Given that, my question to you is, how many different ways can you think of to execute that exposure? Well, you could buy JGB in cash market. You could use futures. You could use swaps. There are many, many ways. Let's just use swaps and cash as the example. Suppose that when you calculated the capital requirement for the exposure, they're going to put on a trade. As you know, as a bank, it has capital requirements and risk weightings. Suppose that when they did the capital requirement, for the same exposure, you get a different capital amount if you use swaps versus cash. That happens. You're either that bank or you're advising that bank. Okay? Which do you select to use? Whichever one has the lower capital requirement. Okay? Now let's suppose that's, 20 basis points, just measuring. You all agree capital requirements are costly, at least from the perspective of the bank. So what would you advise them? You'd say use swaps, not cash. Why? Because you'll earn 20 extra basis points. Now, Japanese banks tend often to be doing the same things. They're in the same business. What happens when a bunch of Japanese banks choose all to go into the yen swap market to buy? what do they need? They need a counterparty, the other side of the trade. Who would be the best counterparty in principle every day? I don't mean on a given day. Well, who would be the best counterparty? It can't be another bank, because the other bank would then have to incur the same capital charge cost, and so they couldn't help them. Banks can't help banks because they're regulated the same way. The best one would be as low regulated institution you could find, one who doesn't care whether it does swaps or cash or whatever, is tax neutral and all the rest. Can you think of any such institutions out there in the world like that, the world we trade in? How about hedge funds? The one thing a hedge fund is defined as is lightly regulated, and usually they are tax neutral in their strategies. So a hedge fund would be the natural, meaning the lowest cost counterparty to these banks, typically. Maybe prop dress, but that's hedge funds. Okay? So where's the market price going to be for swaps versus the JGBs? If it were a theoretical perfect arbitrage, no window, that's the formulas you learned in class, the hedge fund's not going to do the trade. They're indifferent, but they don't do trades unless they can at least pay their employees, their investors, make a profit. So they're not going to do it at zero. So they need to induce them to do it. They need some premium, excess return, to cover that. Therefore, I can't tell you where it will be, but I know that the equilibrium price of swaps at this time is somewhere between zero, from the theoretical, and 20 basis points. Because above 20 basis points, the banks won't do the trade because they're paying more for this, overpaying for the swaps. So let's just say the equilibrium is 10 basis points. It could be lower, it could be 5, or it could be 13. Say it's 10. Well, now the hedge fund will do it because they see themselves making 10. Now they look smart, and they are smart. They come to the bank and they say, we'll do this with you at this price. The bank knows it's 10 basis point too bad, because remember, everybody has the same information. The banks are not stupid. They're not slow in this model. They're not taking the wrong side. They understand. But what will the bank do? They'll take the transaction because while they'll pay 10 basis points too much, they save 20. So I just remind you, this is a very classic example of trade, the reason for trade. Both parties are better off. Unlike the first case, with information, I win, you lose. Do you see the difference? Both win. The bank does better and the hedge fund does better. They both win. That's a different market. It's a different characteristic. It is not an informational-based trade. But what about the hedge fund? You will record an alpha for that hedge fund. How big an alpha? For a moment, forgetting expenses, 10 basis points. Maybe leveraged up, right? And it is truly an alpha. They're earning it. But it's not being earned because of their speed or smartness. It's being earned because they are intermediaries. They are performing a financial service for a fee. But the fee, instead of being paid like a bank fee, is earned by the spread. And therefore, it's recorded as an alpha. So this shows you that you can have a world with full market efficiency and have alpha. The second thing I would compare it with the first one is, how is the cost of trading and scalability? It's different. First, because it's not an information trade, there isn't an immediacy. And these spread moves don't come for 3 hours and leave. They're generally reflecting effects in the market. You see it, another example would be in the UK gilt market, long term. You'll see sometimes the long-term gilt seems out of line. Why? Because British pension funds are hedging their liabilities because they get a regulatory benefit and they need that extra maturity and they'll pay for it. Same idea. It comes out of the same kind of cloth. It's not an information trade. So where do we see this? This means that you can do this slower at lower costs. So it's a less high cost implementation than information. What else is true? It's more scalable. Because the trade is not an information trade, you can put them on in larger size than you would otherwise with an information trade. Okay? So we've seen there's another alpha. And it's there. Now, what if, we're back in the model again, I now eliminate all regulations, all taxes, all transaction costs, all frictions of all kind. Anyone can trade 24/7 frictionlessly with none of these costs. We know what that's called. That's a perfect market. So I now have a model with market informational efficiency, and it's a perfect market. You can't make a market any better than a perfect market. There are no more things you can do. Question, can you have an alpha in that model? Answer, yes. Now, where does that come from? Well, I'm going to do that by exercising my right as a professor. You may not know this unless you had it in class. Professors have the right to do what's called a cold call. All that means is they pose a question and call on someone to answer it who doesn't have their hand up. Hence, they're called on. And I'm going to do that now. Okay? So I'm going to ask a question. Now, who am I going to use? Okay. I notice people put their heads down. Yeah. Okay. Well, you're smiling. You. Okay. Now, you all want to listen to the question as well because you may want to help him. Are you ready? Yes. Yes, you are. Now, just listen. Which would you rather have? $5 million or $10 million? That's the question. 10 million. How many agree with him? I think, if anyone really feels otherwise, see me after this talk. I will give you 5 yuan, $5, 5 sterling for every 10 sterling yuan you want to give me in return. So I think those who may have been tentative with their hands were smart to know it's too easy, there must be a trick. No, there's no trick. So that wasn't so bad, was it? I have another question. Follow up. You did very well. Which would you rather have? $5 million and for the rest of your investment life, a single investment, 10% risk-free inflation-protected bond. 10% risk-free inflation-protected bond and $5 million. That's a pair. Or $10 million and for the rest of the investment life you have, the only investment you have is a 1% risk-free inflation-protected bond. So $5 million and 10% as long as you ever invest, or $10 million and 1% for all you can invest. So it's 2 pairs. Do you have a choice?
Depends on my age.
Well, you know your age. I picked you because of this. Approximately. I don't want to burden you. Give me a guess. What would you think? Or let me ask you this. If you were going to live for one year, one period. Pardon?
$5 million.
That's be the one you pick.
Yeah.
The 5 million and 10. How many would pick the 5 million and 10? You've had more time to think about it. All right. How many would take the 10 million and 1? There's a lot of people didn't vote. Well, you'll notice mine didn't go up for the 5 million. That's because I would not want to be guilty of the sin of hubris. But your answer was the right answer in that it depends on your age. And I picked you, as I could most of the people in this room, okay, to your left or to your right, we got the same answer, because given what I think your age is, you would recognize that if you're going to be around long enough, it's better to accept a smaller amount of money in return for the better opportunity. In fact, I can tell you the exact calculation without approximate calculation without a calculator. Use the rule of 72 if anybody knows it. You know it, right? And the answer is, the rule of 72 says divide the interest rate to 72, it's the number of years to double your money. Well, the difference between 10% and 1% is 9% difference. So you make a 9% higher return. 9%, how long will it take you to double your money? 9 goes into 72, 8 times. So if you take $5 million at 10% and $10 million at 1%, in 8 years they're going to catch each other. And then what happens after? Forever after, you make 10% on the 5 and only 1% on the 10. So the 5 starts here and it crosses like that. You see that? So your instinct was right. If you have a very short period, you pick always 5 or 10. What's the CAPM? It's a one-period model. So in a CMPM world where you want only one period, of course you'll always take 10 over 5. But the real world is not that. Forget about your own lifespan. Think of it for your institutions. I certainly hope you think your institutions are going to be around more than 8 years. Okay? Therefore, what have I demonstrated to you? Why did I take you through this example? You, as professionals, making very seriously my question, many of you have decided you'd be willing to give up half the wealth to get a better investment return. That is to say, there is something else that matters to you as a professional investor besides wealth or end-of-period wealth. And that's the intuition as to why the CPM, which only has one risk, market risk, wealth risk, is not good enough. Because in the real world, we live many periods. And the investment opportunity set sometimes is very good. What I mean by good, I did it with interest rate to make it simpler for you. I could have asked you, which would you rather have? $5 million with this Sharpe ratio or $10 million with that Sharpe ratio forever. And you would get in the same result. So the fact that the investment opportunity changes through time, sometimes it's very good, sometimes it's terrible. Sometimes rates are low, Sharpe ratios are low. Sometimes rates are high, Sharpe ratios are high. We don't control the markets, none of us. The markets give us what they give us. And we can't predict when or how much in the future opportunities will be higher or lower in the market, interest rates or anything else. We can forecast, but that's different from knowing. Therefore, it is a risk in addition to the wealth risk. That means there's another dimension of risk that matters to everyone. I use this example to get the point. Your answer, thank you very much for helping. Okay? I gave that because it's a big example. It's one you can relate to. And you can see why that would lead to wanting to protect against that risk, and therefore it affects your investments. Once you have that, the CAPM is not good enough because you have another dimension of risk that will have a risk premium. Now, the risk premium won't be constant any more than the market risk premium is constant, but there will be a risk premium there. And there are other such things. These risks are, I call dimensional risks, because they say there are other dimensions other than just end-of-period wealth or the market for systematic risk, using your intuition on that is. And that means that you'll have alphas relative to cap-weighted portfolio. The alphas are real. They are improved Sharpe ratios over what you could get from indexing. Their source is the more complex role of securities, hedging other risks, big systematic risks, in addition to the market wealth. Now, let's analyze that one the way I did the first two with you. How fast do you have to get this on? What about the opportunity? Investment opportunity risk has been with us forever. It was around 100 years ago, 10 years ago. It'll be around 100 years from now. This is as much as anything like the market risk premium, permanent. I don't mean the number is permanent, it shifts. But the source, the kind of risk we're talking about, has always been there and is always going to be there because we'll never be able to know what the opportunity set is going to be in the future for sure. I'm just giving this one dimension additional to make the point. So unlike the other two, this one, you really can trade it slowly, which means it's a low-cost strategy for alpha to implement, even compared to the other two. What else is true? Scalability. This is also going to be the most scalable alpha because you're scaling along lines of risks. Oops, sorry about that. You're scaling along lines of risk that are big events. Interest rates. You see what I mean? Not some very narrow defined kind of risk. So compared to the others, lower cost and bigger scale. I'm not saying that's better or worse, it's a different characteristic. So let me stop for a moment, and that's as far as I'm going with different alphas. So what I've shown you is that even in a model, or a model is another way to show it, in a world with market information efficiency and perfect markets, you can still have alpha. A fortiori in the real world, for sure, because the real world is more complicated than we could have those. So I've now shown you these three different sources, and now you might say to me, okay, you've shown me three different sources. That's interesting. I've described to you how they're different in terms of cost of implementation, execution, and scale. Okay, what good or why is this of any interest to us? Why should we consider three different alphas? What do we get out of this? All right. All of this, which is in your books, which I'm passing, is what I talked about on the first slide. That's for you to take home because there's much more detail there. I hope it helps you to remember what you heard. Where I want you to go here now is to a summary of this, what the takeaway is. Three alphas, three different sources. How does that relate to what we do as professionals in terms of getting ourselves to a higher or better risk engine, which is finding alphas and then executing, taking them? Well, the three places where you can improve it. Every asset manager, every buy-side asset manager, right? Big institution with lots of assets, whether internal or external. So you could have internal managers or you can hire external managers. Whichever they are, you have to be answering this question every day. This is an everyday question. I have a manager. I know their past history. I know what they say they do. I can ask them questions. The answer I'm trying to find is, will they produce alpha for us in the future? I know what they've done in the past, but we all know those aren't the same thing. So my job is to determine whether a particular manager is going to produce an alpha in the future. If that manager will, then I know I want to hire that manager, internal or external. Agreed? Now, how can this help you? Well, everyone has past history, but if you understand how the manager makes money, not just that they did make money, it's not a black box, or it's not just they're in equities, or they're not that they're just in, distressed debt on the east coast of the United States in size smaller than $1 billion. But how do they make that? What's the source? If the source is the first alpha, traditional alpha, the one I said most people would answer the question, where does alpha come from? Information superiority. Stock picker, market timer. One's micro, one's macro, but they're both forecasting, picking it. Then, if that's what their source is, that's how you judge them. You say, what do they have that convinces me, other than a past track record, we accept that that convinces me that I think they're going to be a better stock picker in the future to be able to execute. And that takes certain skills to evaluate these people, and they had asked certain questions and wanted to do it. Now let's take another manager who also has historically done well with alpha you're evaluating. It happens to be a hedge fund. And you determine, or they believe, doesn't matter, you've determined, that their source of alpha is financial services. You remember the swap spread making the 10 basis points. How would you evaluate them for the future? We know they did well in the past, but in the future, it'd be a very different evaluation. If they're an intermediary, that's what they're doing, then you're going to be very interested in how they're financed. Are they efficiently financed? Are they a low-cost finance? Because if you're going to be an intermediary, you can't be a high-cost financed entity. You have to be efficient at doing it. How much are they regulated? That is to say, how limited they are. How wide a scope can their team cover? Yes, I know they can cover the swap spread, the yen swap spread. Can they cover currencies in other places? Can they cover mortgages? Do you see what I mean? So why? Because if they could do more, then that's a wider range of financial services. I'm not saying that's better. I'm just describing what they do. Those are the kinds of questions you would ask. Do they have a competitor? If they did very well in the past, that's going to attract competition. Who might be a competitor, for example, to a hedge fund? How about a sovereign wealth fund? Sovereign wealth fund doesn't have many regulations. They don't pay taxes. They don't need liquidity, so that's a good candidate if you're in that business. They have size, they have reputation, and so forth. Why would they be? Because if the profits are big enough, they may determine as an institution that they would have a comparative advantage to do this themselves. Suppose they did. It would be unrealistic if you have many competitors entering that the returns in the past are going to be the returns of the future. I'm just trying to give you common sense things, but organizing how you evaluate it. And it takes different skills to evaluate that than it does a stock picker. So by knowing the source of those two, you can have the right people looking and asking the right questions, the more important questions for the source. Third one, okay, would be the same with the dimensional ones. Where does that come from? Well, that's not forecasting. It comes from the ability to implement that strategy in a certain way. All three are different, therefore they require different assessments, even though they're all alpha. It's not one size fits all. So this is another dimension. Now, that's helping in picking managers. Suppose, I'm just looking at the time here, suppose you have 10 managers who you've now convinced yourself has that alpha. So step one's done. You have 10 managers. What's the next thing you have to do every day? How do I scale how much I own? I know I want to buy them or own, invest in them because they have alpha. But how much do we do? Same amount in each? And how much absolute scale? Well, you know what that depends on? More than alpha. It depends on, for example, how correlated the 10 managers are and how correlated they are, let's say, with your benchmark or, let's say, the market. If you had 10 managers that were independent of one another, then you know the contribution to risk is very small because it diversifies across 10 managers. If you have 10 managers who are almost perfectly correlated, that's like having one manager. So clearly, you need to know more than alpha. Agreed? Now, in that task, what do you do? Well, of course, you look at historical data and see if they're correlated. We do that now. What else do you do? Because you never just let the data tell you. You put on your judgment. What would you say? Well, let's look at hedge funds. Suppose there were 10 hedge funds. One of them in convertible bond arb, one in emerging markets, another in long-short equity, another one in fixed income arb. There's a whole list. And there are 10 of them. And we know they have alpha. So we say, these are probably pretty independent. They're in different asset classes, right? And they have completely different styles. So intuitively you feel they're pretty independent. You agree? I mean, I'm not talking about, you already have the past history. I'm talking about when you're making judgments, why you get paid. Because if it was mechanical, professors like me would put it on a USB port and sell it for $39 and nobody would have a job. But it's precisely the judgment in these things that I'm talking about. So that's an argument you might hear. And that's not a bad argument, but what do you know now? If you agree, or you think that might be, that the principal sources for many, if not most hedge funds, of their systematic alphas comes from the function or the role of financial service alpha, then what do you know about these 10 managers, these 10 portfolios? They're all in the same business. They're all providing financial services. And if they're all in the same business of providing financial services, in certain conditions for sure, they're going to move together. Obvious place would be 208, 209. Would you want to be in the financial service business intermediating? I don't think so. But of course, you don't get to choose, because nobody can forecast that until it's too late. So what I'm pointing out to you, not that you shouldn't use the asset class, not that you shouldn't use style as a way of looking at it. But I'm trying to show you is that understanding the source gives you material additional information to better assess the risk. That's the bottom line. So that's the second. So first, testing, likelihood of alpha in the future. Second, if you've accepted on alpha, the risks among them in order to scale the amount you hold correctly. And third, this is for the CEO and the CIO. Very important. The CEO, CIO in an organization determines the structure of how you organize what's done. How you manage what you do. You have, for example, some will be organized between active and passive, two categories. So you understand what I mean, if you want the organizational chart. But more than just the chart, it's the teams and who's together and what and how you put them together. So let's say we just had active, passive, then we could have other dimensions, but those two. And then along comes a new hot thing to look at called smart beta. Is smart beta active? Well, it's certainly not active in the way people normally have thought of active, right? Is it passive? No, because passive says we're indexing. We're simply mechanically exercising to a very clear thing at very low cost. So now you're trying to figure out who should look at this. Who should look at the strategy and who should evaluate the managers? I know this sounds sort of silly because you say, well, you ought to be able to, but this is real because you have to have a way to do it. I would suggest, not that it's an answer and not to abandon what one is doing, that if you were to break your org charts along source, then you would, one, I think, find that many strategies that look new, if you break them down to sources, you see that some of them are purely stock picking, or if you like, or they're just information. Some may be financial services, some may be the last one, or some may be mix of two or even three. There's nothing that says you have to be a pure version. That's not dictated. The beauty is if you've broken along these lines and you think along these lines, if you look at a strategy and you can decompose it between, let's say, number 2 and number 3, or number 1 and number 2, or some combination, then you know which teams to assign. One team that's on the, will evaluate that part of the strategy, which is their XPs, the other, and then you can come up with a composite. Because this year it was smart beta. Next year it's going to be dumb alpha. There'll be new strategies always. And so if you can find primals, ways of looking at it that are more robust, that may be helpful to the management of the organization. So in summary, I've tried to show you first, thinking about the sources, why they're different, to give you the real intuition. I mean, we had their equations for all this. All this stuff was worked out in theory long ago, and you have some of the references. But in terms of really applying it and understanding it, you see they're different. And I've at least tried to suggest to you 3 important areas that are everyday activities where I think it may help. Help you better understand the managers evaluate, help better understand and do performance, and help better understand the risk characteristics. So that's what I really wanted to say about that. And I now have a few more minutes, like 10, right? From when I start. I mean, you see how I'm checking time. I'm very sensitive that it's easier for me to be up here than for you to be out there in the audience. So let me move now and say, I'll take questions later, but let me just say, that's the story I wanted to talk to you about. Understanding the characteristics of alpha and how this can help you to do the first step of building the biggest Sharpe ratio. Okay, now I want to move on to goals-based approach to investing, the second part. And given the time, I'm first going to describe, I'm not going to go through these examples, but I'll show you they're there, other than to say probably the best known example in size in the world of goals-based investing that you would all be familiar with, not necessarily that you do it, but you know, is liability-driven investment, typically in the area of pension liabilities, either pension funds or insurance companies who are writing annuities, or insurance companies that are guaranteeing pension, are taking on the pension obligations. Retirees, I mean, providing their life element of it, okay? I hope that's familiar, that you're aware of it, not that. And so, what is the goal typically? The goal for an asset fund, the fund that's being managed, is to try to fund 100% of the profit that what was promised. If you get to 100%, you've paid it all, you've achieved your goal. That would be nirvana. That's the best. Portfolio, why do you have the portfolio? It's there to help pay for the liabilities that you've incurred. The best you can do is to cover them all. So the goal is almost always to try to fund 100%. But of course, goals may not be achieved. They're what we aspire to, but we may not achieve. And we certainly are rarely able to get there without taking risk. So then it's usually the goal is fund 100%, a funding ratio of 100% or 1. Cover all the liabilities. We'll all go out and celebrate with a big bottle of champagne. But then we may have a risk constraint such as, but we must be able to at least cover 50% or 60%. That becomes the risk constraint. This is an example of a goal. A goal is what we're trying to achieve, and then the elements around it, which include something about the risk that we're willing to take to it. And then you're focused on achieving that goal. For example, follow a strategy subject to the risk constraints that maximizes the chance of succeeding in reaching the goal. Do you understand? That's what we mean by a goal. LDI does that. The investments are driven by the liability, by the goal. The goal is to pay it. Did everybody catch that? Now, before I jump into that, I promised you why I say why I think goals-based investing generally, not just for retirement, is going to grow. We're all of us, internal or external, trying to get people to hire us. And so we compare things. Now, the normal way it's done, typically, is who has a higher Sharpe ratio, or at least who does the client think is the higher Sharpe ratio. And you know that's very competitive. There's a huge number of people doing it that are very talented and work just as hard and have access to the same data. So guess what? When the prize is big It attracts lots of competition. It gets tougher and tougher to get a higher Sharpe ratio. And in fact, it might turn out sometime that I'm trying to get a mandate and he's my competitor trying to get it. They're down to the two of us. Now we both have to be pretty good or we wouldn't have made it to the finals. So he's got to be pretty good. And I wouldn't admit it, but the truth is he's got just as high a Sharpe ratio as I do. I've done everything I know how, but he's just as good as I am in that domain. So how do I try to get the mandate? Because I still want to get the mandate. Now, I might try to take everybody out to dinner or something. That's not going to work, I don't think. So what else did I do? I asked the client more questions. And I say, what are you really trying to achieve with this portfolio? We all know we like more risk per return and all that. And there are all these different strategies, 70-30 or whatever. Okay? But what are you really trying to achieve? Now, in the case of LDI of a pension, you know what they're saying they want to achieve. They want to be able to pay off the liabilities, and they show you what the liabilities are. They're not hypotheticals. If you tell me that, in particular what you're telling me is, I then say, by the way, that's what you want to do with this, that's your goal, then I'm going to show you what I'm going to do. He left for the day. He showed his Sharpe ratio and left. I stayed a little longer. I showed him my Sharpe ratio, which is the same as his. I say, here's what I'm going to do. I'm going to manage the portfolio, subject to the risk constraints, to maximize the chances of getting you fully funded. And I'm going to show you that what I'm going to do is going to improve, have a better chance than what he showed you. Now, how can I do that if he has the same Sharpe ratio? The answer is, he needs a certain amount, usually in retirement measured income, but he needs a certain amount. If we get him that, we've solved his problem. Sure, everybody would like more, but he doesn't need more. What he needs is to get to that goal. And so the trade-off I'm going to give him is give up doing better than the goal, getting more than 100% funded, and I will get you to the goal with a higher chance than he does. Do you see the trade-off? It's not magic. It's not a free lunch. But I think if I understand the goal and he agrees with his own goal, he'll like that. Because what he really cares about is getting this thing funded. Not funded plus a boat. Or not funded plus a fun surprise of extra money. They're all nice. But his most important responsibility is to get to the goal as best way he knows how. And I'm going to do it not by magic. I'm going to do it, and I'm going to tell you quickly because of the time. I'm going to do it by effectively, not actually, selling off the upside, the chance to get more than the goal. That's basically selling off a call option for those of you who understand. If you don't, just think conceptually. That has value. If you don't agree with that, see me after the talk. I will buy all of your upside for nothing. So it has value. I sell that off, or in the way I do the strategy, that gives me resources. What do I do with the resources? Improve my chance of getting to the goal. In effect, I will do a dynamic strategy with the same Sharpe ratio that he has. But I'm doing something different because I'm focused on achieving the goal. And I'm focused on getting him fully funded, not 10% funded unless he tells me that's the goal. But whatever the goal is he's agreed to, I'm focused. And I'm going to use those resources to increase the chances. So everywhere between where we start and the goal, I have a better chance of getting him there, or I have more for him when we get there. On the other hand, if there's upside beyond the goal, I don't give that. If he's doing that, then you'll get it. So why I point this out to you, I'm trying to do it in basic understanding, nothing about the math of it doing. I've told you how you do it. But why I think this is going to work is because I can't keep saying I bet a better Sharpe ratio. Too competitive. But I can be better in providing the service that he needs by spending more time and focusing on what he needs. And by doing that, I can improve my chances of getting him where he wants to go without having a better Sharpe ratio. And what I want you to hear, it's not magic. That's why I believe this is the direction of the future. And by the way, it sounds reasonable anyway, right? You're treating your client more custom. You're more attentive to what they have. You have to work harder because you have to focus on the goal. Because, of course, if he has the wrong goal, I mean, you thought you were going to get him to San Francisco from Seoul, but he really wanted to go to Dallas. I did the most optimal travel arrangements to get to San Francisco. That's a mistake. So it's not free. So that's goal-based. Now do I have 5 minutes more, or are we? Yeah, okay, because I want to show you some pictures to illustrate how important one, goal, and more importantly, the right measures. So let me just, whoops, going the wrong way. Okay, let me point out, remember I mentioned when I showed you at the beginning of my talk, the optimal common ratio of risky assets. And I said to you, that is relatively insensitive to the goal. That's the assertion I made. But then I said the risk-free asset, which is the other thing we mix dynamically to optimize the goal, right? The risk-free asset is very sensitive to the goal. So let's stick with the pension fund liabilities as an example, because that's so well known. What is the liability? What is the goal? It's not an amount of money. The liability is a stream of income paid to people, whether it's an annuity of an insurance company or a pension fund benefit or a government Social Security payment. All of what's promised is in the form of benefits, income. Income for a period of time, may be uncertain because of life or not, but it's an income goal. Agreed? What is the standard measure for risk and return that we see mostly used? It's a wealth goal. We look at the value of the portfolio's change, not the change in the amount of income. For those familiar with pension investing, because the liability is income, the relevant thing that they're concerned with is not the value of the assets of the portfolio, it's the funded ratio. The funded ratio is the value of what I could buy in future income today to the value of the income that I promised to give. That's what really matters. Not the dollar or the won or the sterling value of the portfolio. Because that's the liability. Agree? Now, what this is designed to show you is how far off the mark in terms of even thinking about risk return, measuring risk and return, let alone doing something, you are if you have your goal as income goal, as pension funds, annuities for insurance companies, but you manage it with risk return measured in dollars or won or something else, standard portfolios. In a standard wealth portfolio, what's the risk-free asset? Treasury bills, right? Minimizes the variation, right? Or real treasury bills if you're inflation, I don't care. In whatever currency you designate as the one you want, right? That's the gold standard. Is that the risk-free asset for a pension portfolio? No. Because the pension portfolio, the risk-free asset, is something that assures that the amount of income needed is there. What kind of asset does that? A very long-dated, because these liabilities have payments far in the future, very long duration income asset. Now, this little piece of analysis, not deep, but I did, is designed to show you that people who say, that's okay, get the right amount of money, the number as the goal. And, interest rates may be higher or lower, but it'll kind of work out 4% or something. And it's good enough to get the right amount of money, because who knows what interest rates will be. They may be higher or lower. And in the long run, they're going to be some number. I want to show you that that good enough is not good enough. Not close to good enough. The way I chose to do it was, I took a 45-year-old who's going to retire at 65. What's the risk-free benefit for that person? It's an asset that pays nothing for 20 years and then a stream of income, so much per month, for the rest of that person's life, let's say 20 more years. So basically, it's a very long duration fixed income instrument. Forgive me, I did this in US dollars, and I used the US TIPS market. I'm an inflation guy, so I'm talking about real income benefits. This, I constructed a artificial, if you like, instrument that looks like that. What do I mean? I mean, take that thing that's 20 years and then pays. Think of it as a deferred annuity, if you know what that is. Okay? That may not trade, but we all know, for decades, we're capable of trading in the fixed income market. What is there? Matching the duration and other moments, so we can approximately, and often pretty well, approximate the actual asset by trading in that. You all know that. That's a pretty standard procedure. That's what you would do if you were an insurance company who has sold an actual annuity and wanted to hedge the market risk and everything because the board doesn't want balance sheet risk. That's the strategy you would write. That you understand, that's the dynamic trading to get the duration to match so that the assets will match the liabilities. I created that with TIPS, and then we did the monthly returns from 2003 on to the 12 or whatever. I stopped here. That's the risk-free asset for that 45-year-old. Does that pattern of monthly returns look risk-free to you? Very volatile, isn't it? Why? Because I'm measuring it in dollars. The way we normally measure an NAV portfolio, the way you report things. In fact, in the United States, in the DC plans, we are required by the Department of Labor and the SEC to report the change in the value. So right away, you see that this is a pretty hard thing to tell somebody. You send them that, your reports, you send them look like that, and you tell them you have a risk-free asset. If you measured the same asset, not in dollars, but in income units, think of it, for those who know the term, in funded ratio. In other words, you scale it to income, not to wealth. Then because we created this thing to match this person, it actually has no risk and no return. It's just, we already bought it. Do you see how different those two look? Let me go quickly to the next one. Whoops. Can I back up? There. Maybe a more familiar one is, what's the gold standard, as I said, for US dollar value to protect US Treasury bill? I rolled over 90-day Treasury bills in the same period, and what do you see? What you expect. Low returns, low volatility, and nothing negative. That's what you expect, right? But what happens if we measure that in terms of income units, as would be the appropriate measure for the risk of assets that are dedicated to the liability of paying this 45-year-old a stream of income in 20 years? Then it becomes one of the most risky assets out there. Why? I need tell you nothing more than remind you that 8 or 9 years ago in the United States, you could walk into a bank, get an insured certificate of deposit, and get 4 or 5%. On $1 million, 40 or 50,000 a year. All right. What could you do with today? 10 basis points? That's $1,000. Now think of the story. I'm your advisor, at least for the moment. I say, you told me you were very risk averse. So I put you in Treasury bills. Throughout the crisis and everything, look at what I got you. Safety. And then you say to me, but I actually try to live or help me live on my income. And I used to get $40,000 or $50,000 a year. I'm getting $1,000 a year. I can't live on that. And it's not because of inflation. There's no inflation. That's not the problem. The problem is that the real rates changed a lot. Well, they don't have to change that much to change price a lot, but they did change a lot. There's no answer I will have to you. I can't promise any way out of that. You've just lost. Why? I can't say, oh, rates will go back up. Don't worry. Because if you believe that, then you have to explain why professional investors buy U.S. Treasury tips 30 years at auction in November of 2012, 50 basis points. 30-year money, 50 basis points. This is not irrational exuberance of taxi drivers, ribbon clerks, or college professors. This is one of the most professional investor markets in the world. If all the professionals understood that long rates are going back up, not worry about it, why were they putting out billions of dollars at 30-year money at 50 basis points? If everybody knew it was going to happen, we should fire them all, maybe throw them in jail for improper investing. The answer is maybe rates will go up. Maybe that's even a good speculation. But that's not something you can say, don't worry about it, or it's going to happen. There's no one in this room can do that, or I wouldn't advise you to. And that's what I'm trying to bring home to you. This is a very big difference of the goal. The goal you pick and what you call the risk-free asset really does matter. And so I think on that note, I will show you one more picture. Oops, if I ever go in the right direction. Oh, there. There's the risk-return frontier. I had to show you one of these if I come to investment. There's the Treasury bills during the period. That what I call annuity is that bond portfolio I showed you, the one that's the surrogate for the risk-free asset for the 45-year-old in income. And that's just MICI world as a surrogate for equities. Treasury bills, low risk, low return. Stocks, high risk, high return. This doesn't look very good. High, almost as risky as stocks, low return. Now let's measure it in funded ratio or income units, the actual goal. The annuity by construction is risk-free. That's how we designed it. MICI, the stock market, yes, it's at a different point because it's like a different currency, but notice this was high risk, high return. This is high risk, high return. There's Treasury bills. That's a disaster. So the point that I just wanted to close on and open up for your questions if you have time is goals-based investment is important. It's the future. And risk and measuring return has to be done in the right units. If I'm not even measuring risk and return in the right units, I think Treasury bills are safe when they're actually very risky, and long-term bonds are safe, but we're treating them as risky. If I don't even measure risk right, how can I possibly manage well? It's as if I optimized in the wrong currency. It's just, it's more basic than, improving. You're flying blind. And this will always be true if the goal deviates from being a wealth goal, even if it's a mix. So that's my message. Goals-based is important. It's part of the fundamentals of investing. I believe it's going to be the important wave of how things are going in the future to improving. Much more emphasis on that. And if you don't measure in the right units, you have no chance other than being lucky. But I don't know how to create that. Maybe you should hire a lucky person, okay, to make your decisions. But luck, I can't tell for you. I can tell you, if you measure it wrong, your chances of getting it right are not good. So that's my sum. Thank you very much. I'll take any questions.
Me.